with AML Right Source. And with me for the third time, I'm real pleased to say, is banking law expert and author Tom Vartanian. Tom has written extensively on a whole host of issues. His two most recent books that we've talked to him about in the past are 200 Years of American Financial Panics that he published back in 2021 and The Unhackable Internet that he published in 2023. He's also the executive director of the Financial Technology and Cybersecurity Center. So first of all, Tom, thank you so much for taking some time today. I really appreciate it.
Thank you very much. And I feel like Eric Clapton being inducted into the Rock and Roll Hall of Fame for the third time.
That's right.
Nice to be here.
Steph Casella, who I know you know as well, has done 5. So we haven't got a jacket for him yet, but we are working on some swag for our multiple folks. So anyway, so there's a few things that I want to talk to you about. You're a very prolific commenter, and I mean that in a positive way, on a whole host of issues, and especially now with this new administration. There is obviously a lot of questions about a whole host of issues, but I wanted to talk about at least 3 and get your take on them. The first one is not new to this administration or a new issue, and that's the problem with fraud in terms of online scams. Again, you've talked a lot about the internet. Your book, The Unhackable Internet, is fascinating reading. But one of the things that I saw was a recent op-ed back in August that you wrote about, and the ongoing issue of pig butchering, of relationship scams, romance scams, elder abuse, whatever you want to call it, but situations where individuals, for a variety of reasons, get caught up in various either phony business opportunities or phony relationship opportunities, and obviously lose a lot of money, some money they can't afford to lose. Others ongoing over a number of years. And part of the question is always, how much should the financial sector do regarding either working with customers who've been scammed or explaining to customers why this is an issue and how to do it? So I know you have some, I won't even say interesting, but you have some very solid views on that. Talk a bit about what your take is on online scams.
Yeah, so, for 50 years, I have been doing and thinking about financial services. First as a regulator, lawyer. I've represented just probably every aspect of people in financial services. And I've seen so many different things over these 50 years, and they've all sort of come together since I've retired, and I don't have any clients whose views I have to articulate or be careful I don't step on their toes. And, let me give you a few bottom lines here that I have reached. And many of these are in the Unhackable Internet book. But number one, the internet, the web, whatever you want to call it, and they are 2 different things, but I call it the internet just for shorthand. The internet is woefully insecure, and we are incredibly vulnerable on it. And what I mean I mean every individual, every business, every government, right? And so if you start with that premise that in 1969, when it was handed off as the ARPANET to 4 universities to trade research, there was nothing about it that was secure. It was never meant to be secure, never meant to house all of the information and all the data and all the money in the world, which it does now, right? And so you start out understanding that we are dealing with an incredibly insecure environment. I mean, look, we share the same internet with China, Iran, North Korea, and Russia. I mean, that's just nuts. I mean, it's absolutely insane. And so when you talk about online scams, I start with the understanding that the internet is a place where that's going to happen far more than in real life, right? Frankly. And that there's nothing out there that can really protect us except ourselves. And so much like I came to the conclusion when I was doing consumer law back in the 70s at the Control of the Currencies Office, and I concluded that the best way for consumers to protect themselves, to be more literate in terms of financial literacy, I believe the same thing here with technology. most people, their relationship with their computer is they touch a button, it goes on, and that's about all they know about technology. And if that's all you know about technology, you're in big trouble, because you're playing with fire. And so the question becomes, where do financial institutions come in, right? In a world where they can't stop people from doing dumb things, they can't make the internet more secure, right? And what can they do? And the problem is they can't babysit. I hate to use that word, but they can't babysit every client that they have. It's just not physically possible. The same way the regulators can't look over the shoulder of every consumer out there. And so I think there has to be a joint effort by government, private businesses, and individuals to increase financial technology literacy, or technology literacy as a whole. But when I get asked that question, what I always say is, if we're not prepared, and so far we haven't been prepared, if we're not prepared to make authentication online a real thing as opposed to a false thing that it is today, because we don't authenticate people, we authenticate IP addresses, right? If we're not prepared to have real authentication, if we're not prepared to have real governance, and we're not prepared to have real enforcement online, it is going to be heaven for the people who want to rip other people off. And that's the problem. I think there are band-aids that we can put on it. Banks can educate their consumers as much as they possibly can. But at the end of the day, if we don't make the internet more secure, this is only going to get worse. It's only going to get worse and worse and worse. And there's a great book out, Traces in the Dark. It talks about the worst of online crime, particularly child sexual abuse material that is proliferating because of online crime and Bitcoin. Bitcoin's the great financer of online crime. So, unless we're prepared to fundamentally change the way the internet works, I think we're all at risk.
What's your sense, is anybody taking on this clarion call to make change? And you see is there any optimism that there will be adjustments made? It doesn't seem that way to me, but you're much more engaged in this than I am.
Yeah, I cited a number of efforts in the book by people who see the problem and are trying to create alternatives, trust advocates online, new software, new ways of protecting people. The problem is, and I think the problem is very clear to me now, having done all the research and interviewed all the people for this book, unless you make it expensive enough for businesses to have breaches, they're not going to take the extra effort to fix the internet. They're just going to go along and do what they're doing. I mean, when you look at financial institutions and other companies who get dinged for breaches of security, right? It's not even a decimal point on their balance sheet. It's a cost of doing business, right? And so if you say to them, should we create an effort to fix the internet, which will be costly and users will be unhappy, or stay with what we're doing? They'll stay with what we're doing, because I don't think, and I say this in the book, I don't think businesses have enough liability for what happens online. And unless they have enough liability, they're not going to make any changes. So I think have been efforts, but the problem is it's expensive. It will make changes that are inconvenient, and users will hate it.
This is probably naive of me, but I have noticed in the past few years that companies have increased the use of multi-factor authentication, more extensive character passwords. I'm assuming that there's some value in that, right?
Yeah, there is some value. The problem is that multi-factor has got to be in the realm of 4 or 5 factors before it really gets to be extraordinarily effective. 2-factor authentication, I've talked to a number of experts who say that's probably 50 to 60% effective, which is still pretty ineffective in terms of online security. But look, most of the security breaches, most of the online scams take advantage of human frailties and human mistakes,
Sure.
right? a lot of the ransomware is taking advantage of employees who fall for a phishing email. And the next thing you know, there's a ransomware attack on the company. And so I think that, look, you're never going to change human beings from being frail and making mistakes. What you have to do is you have to limit the number of mistakes they're going to make online and limit their frailties. And that is technological education. And it also is, as I said, better authentication, better governance, and better enforcement. And lastly, the other thing I said in the book, you probably remember this, is that when you and I started in banking, there was no such thing as open architecture networks. It was only proprietary networks. Every bank was connected to the Fed or to Visa, MasterCard, and it was all proprietary networks, right? And so I don't understand why we can't go back to proprietary networks where you have to have a passport to be on that network, and you have to clear a number of hurdles before you can even be on that network. The whole question of open architecture network, when you're trading the total value of securities and money that the world has, is a little bit insane to me.
All right, let's shift gears. Another piece that you wrote for the Hill was an op-ed piece that's when I reached out to you about the response in cryptocurrency from the Congress here regarding the issues of stablecoin, but the Genius Act. Everybody was, not to say everybody, but there was this groundswell of support from both sides of the political aisles that this Genius Act was going to put guardrails around crypto. Things were going to be safer. Obviously, they just proposed notice for comment for the Genius Act. You have a different take that it's, I'm paraphrasing, but it's all about trust. And maybe that trust is going to be hard to come by. Talk a bit about that. Again, I know it's more complicated than the way I described it, but talk a bit about that.
Yeah, no, we could talk, John, for 4 hours on this, but let me sort of boil it down to the following. Let's put aside for the second that cryptocurrency as an investment is at best speculative, right? Because there's nothing there. There's no there. And as an investment, I'm a big believer in letting anybody invest in anything they want. I let them lose their money as long as they get disclosures. I don't think anybody gets a lot of good disclosures here, but let them lose money in any investment they want. The problem is cryptocurrency is doubling as a payment mechanism. And that's where I find people are not thinking about it the right way. I don't think Congress is thinking about it the right way. I don't think the regulators are thinking about it the right way. It's got to be regulated as an investment and a payment mechanism. So if you look at it as a payment mechanism, what's the highest and best use of cryptocurrency today? It's to finance global crime, right? So I ask myself, why are we stretching and trying to facilitate a form of money whose highest and best use is the facilitation of global crime? It doesn't make any sense. So if you start with that as a predicate and you say, well, now we need some payment mechanism that has a stable value because you can't use Bitcoin because it may be $20 higher in the morning than it is in the afternoon. So let's go to stablecoin. So the stablecoin right now, what's its highest and best use? Well, its highest and best use is the purchase and sale of cryptocurrencies whose highest and best use is the financing of crime, right? So I'm not sure why we're stretching out here, except for the fact that the industries have made enormous amounts of political donations to influence this kind of stuff. I mean, look, when people say, how did FTX happen? How did Sam Bankman-Fried happen? All you have to do is look and see in one election cycle, he gave $100 million to Congress. That's how it happened, right? Because nobody was looking. And he all of a sudden became some sort of phenomena because he gave out a lot of money and invented something that turned out to be nothing. And so my fundamental bottom line, I said in this article, is that put all that aside. I said, I can't seem to get people to really focus on that because the culture of technology is to be fascinated by these shiny new instruments until they're not shiny anymore, right? But put that aside and just think about financial services in this country over the last 200 years. We started out where we're going. We started out with segmented, divided forms of payment. Each bank issued a note. We had bridges issuing wooden nickels. And that currency was good in a very locally limited area because why? Nobody left those locally limited areas. You couldn't travel very far. And then as the country began to grow geographically and product-wise, that system collapsed in and of itself. And we needed a national currency. We needed national banks. We needed clearinghouses. We needed Federal Reserve, central bank, right? And so all of a sudden we figured out that that segmented system that relied on individuals wasn't going to work in a big country which needed trusted intermediaries to act between the persons who were out there. And we built a sophisticated system of trusted intermediaries, and whether they're banks, securities firms, clearinghouses, securities clearing vehicles, whatever the case may be, that system took a long time to be perfected, and it works damn well good, right? It really works well. And all of a sudden, and what I said in the Unhackable Internet is this is as much cultural as it is financial. All of a sudden, that system is looked upon as being a bunch of Luddites trying to skim something off the top of each transaction, right? And so what we're doing is we're saying, well, let's throw out the trusted intermediaries because we don't need them. First of all, they slow down the process and they make it more expensive. And let's go to a system where there are no trusted intermediaries. So what does that mean? That means that we're back to the 1800s where I got to know the person I'm dealing with, right? Because I have no trusted intermediary to fall back on. And the trusted intermediaries that are being offered to me, if they're the Sam Bankman-Frieds of the world, I'm not relying on them. So I find it interesting that we have perfected a system over 2 centuries, which focuses on institutional trusted intermediaries. And now we've decided we don't need them. And that culturally, cryptocurrencies without those kinds of intermediaries and stable coins without those kinds of trusted intermediaries is a better system because it'll work faster and it'll be less expensive. And you know what? It may work faster. It may be less expensive, but there will be more catastrophes in that system also, because all you have to do is look back at the history of where we've been.
Now, if you were to file on behalf of your center a comment letter on the Genius Act, high level, what things would you point out besides what you just talked about? What things would you point out that you think we could leave aside whether or not the commenters are going to pay attention like we always do? You and I have filed comment letters for 40, 50 years. So we know how that process works. Sometimes it works, sometimes whatever. But bottom line is, what sort of things would you call out that these agencies need to understand? And then I'm going to ask you right after that about the way they're reformatting what agency is going to be in charge, because I think that's an interesting area of policy as well. But just in general, what would you call out?
I'd call out a few things. Number one, I would say that we have to focus on number one, we have to focus on cryptocurrency and stablecoins as an investment and a form of payment. And they have to be regulated differently depending on whether you're looking at them as an investment, a commodity, or a form of payment, right? And that's very important. And number two, I would say we have to make sure that we haven't created unintentional loopholes that create unintended consequences in the stablecoin legislation. Meaning, for example, what happens if exchanges say we'll pay the interest on the issuer's stablecoin? The issuer is restricted from paying interest, but the exchange isn't. And if that happens, the Treasury's estimated that $6.6 trillion of deposits could leave the system. Well, the system's only got $18 trillion. Right. 1/3 of the system disappearing into stable coins, into some esoteric different area of the marketplace. It means that much less lending by commercial banks, right? Whether it's homes, cars, businesses, and that is changing the economic framework that we've developed. And in the Wall Street Journal editorial that I put out, that I had last week, what I argued was it was that kind of indifference to the changes in the flow of liquidity and capital in the country that caused the failure of 3,000 banks in a huge recession in the 1980s, because money market funds came along. And listen, I'm all for technology. I'm all for innovation. I'm all for pushing the banking and financial services business to modernize as much as they can. But when you've created these huge infrastructures with trusted intermediaries that move so much money, and then you pull the rug out from under them overnight, you're going to end up with some instability and some problems. And that's what money market funds did to the banking business by sucking out trillions of deposits very, very quickly from the banking business, because the banks were subject to Reg Q and the money market funds were paying 12% in the marketplace. And I equate it in some cases to some work I did before I retired. I represented a number of banks and credit unions in New York who had funded taxi cab drivers who bought medallions. The medallions were going for upwards of $1 million. They would make a loan collateralized by the medallion, right? And then Uber and Lyft came along, and the medallions all of a sudden were worth $300,000-$400,000 at most. And so the banks had no collateral. The taxi cab drivers weren't making as much money. They started defaulting. Banks started failing. And it's the problem with asymmetrical regulation. We tend to over-regulate the banks for reasons that I think are historic, nothing else, and underregulate everybody else's in financial services. And I've said this several times in both speeches and in the book. I went back to 1933 and I calculated consumer deposits, consumer dollars, right? And at that time, about 95% of business and consumer deposits were in banks, flowed through banks. Today, the number is somewhere between 30 and 40%, which means 60 to 70% is outside of the banking business and is unregulated like the banks are regulated. It is that asymmetrical regulation that constantly, again and again and again, distorts the marketplace and ends up with aberrations that turn into financial crisis. And so I think what we've done is we have overestimated the value of stablecoins and cryptocurrencies and underestimated the potential impact on them and on traditional financial services companies. And if it ends up in a massive disintermediation of traditional financial services companies like money market funds did in the early 1980s, we're going to have a problem.
The comment you made about loss of deposits was raised by the various banking associations after the Genius Act passed, which was, as a former lobbyist lawyer myself, why didn't you folks raise that as they were going through the process? I know that's going through, but who's in charge now? They had the battle with the CFTC. You don't have to spend a ton of time on this, but give us a couple of minutes on who's in charge overseeing all this, because I think obviously that's relevant, and I know you have thoughts about it.
Yeah, no, I think the Treasury's in charge in terms of calling the shots on this kind of stuff. I think they're going to be in charge in terms of this agency that sets stablecoin regulations. My problem is, tell me what the goal is. Tell me what the goal is, and tell me how much you know about this problem, about the history of financial services, about what can go wrong. And, when I was appointed general counsel of the Federal Home Loan Bank Board and the FSLIC in the middle of the savings and loan crisis, I was 31 years old. I didn't know anything, right? And luckily I had a chairman who was brilliant and had great instincts. And we all learned very quickly from him. But, I think the problem is that we've got people in regulatory agencies and they're not able, I think, to both balance safety and soundness, lending requirements, risk management, and technology. And they're not paid to do that. That shouldn't be their job. And the question becomes, I know the Bank Policy Institute's raised this question in a number of papers, and that is, should cybersecurity and technology be regulated by a cybersecurity and technology agency? And I think that's a good question to ask at this point in time when you say who's in charge in terms of all of this stuff. But it leads me to the question I know you and I have talked about, and that is, what should the regulatory structure look like now in 2025 that was essentially created between 1933 and 1940, right? I have talked about it in my 200 years book, and I wrote about it recently. If you wanted to create a system that was guaranteed to be highly efficient, you'd create the system we have right now, right? I don't know why there's an SEC and a CFTC separately from each other, except for the fact there are different committees on the Hill that regulate them and don't want to give up their jurisdiction, oversee them and don't want to give up their jurisdiction, right? I don't know why we need the Federal Reserve Board regulating banks as well as monetary issues. I don't know why the FDIC has to regulate banks as well as have an insurance fund. And so what I would do, if you look at this academically, if you look at it unvarnished, in an unvarnished way, and I spent time in three different agencies, I guess, and I have my own views about who does what, but I think if you look at it objectively, you say, we need one banking commission. Well, I don't care what you call it. I called it the Federal Financial Security Commission. Why security? Because I believe cybersecurity is a huge part of what should be involved in financial regulation these days. And I would put in that, the vice chair of the Fed for bank supervision. I would put in the undersecretary of Commerce. I would put in there the head of CISA for cybersecurity. I would put somebody from the Fed. And controversially, apparently from what I've heard in feedback from what I proposed, I would put at least one executive from the financial services business on that board. Because I believe that the agencies are incapable of keeping up with what's happening in financial services. And if you can bring the staffs and the expertise of executives of JP Morgan or Bank of America or Wells Fargo to that regulatory agency, I am sure we can figure out how to deal with the conflicts. But I want the input from those people. I want those people to have skin in the game of regulation. I want them to be invested in regulation, and I want the industry to be invested in regulation, as opposed to the adversarial process we have created where it's, cops and robbers. The cops and robbers system isn't working, and it's not going to work in a technologically energized environment. And we've done this with cybersecurity. We've done it with plane crashes at the Department of Transportation. We include executives from the private industry in the process of determining what we should be doing and what went wrong. And to me, that makes enormous sense.
In the world that I inhabit, the anti-money laundering CFT world, we've been pushing for years a very similar approach, because in the AML world, I sort of call it the three-legged stool, right? With the regulators, law enforcement, and the private sector, and there needs to be a partnership. And that partnership is fractured a bit for a variety of reasons, but part of it is what you alluded to before. The regulators have a different job. Law enforcement's job is to process the information, investigate, prosecute, what have you. Regulators, it's about policy, some about operations. And so I think that analogy works more broadly in what you're talking about. So I think that's an ongoing issue. All this is really good grist for the mill. I do want to give you an opportunity. We talked before we jumped on. I didn't think we'd be able to play this before your webinar, but it looks like your webinar is October 30th from 9 to 12:15, and it's entitled The Great Tech War. Can we optimize innovation, regulate AI, protect children, and address social media content at the same time? And those are all issues that our world cares about. Wet our whistle a little bit. What can people expect? You have a really lengthy group of panelists besides yourself. What are some of the things besides what's in the title that you're hoping to accomplish during that webinar?
Well, the first thing I worked on in 1976 as a lawyer at the OCC, one of the first things was the failure of Franklin National Bank, which started my life in bank failures. 1,500 bank failures later. But the other thing I worked on was the approval of national banks creating ATMs. It was my first foray into technology, financial technology, which increased dramatically in the 1990s. But what we're going to do with this webinar is sort of look at the top controversies that are going on right now, because one of the things that I've sort of noticed over the last 15 years increasingly is everybody wants to regulate the internet. Well, you can't have every country and every state and every municipality regulating the internet, because then the internet won't work, right? I mean, you just can't. It's for example, I represented a lot of financial institutions in this country that did nationwide home lending. Dealing with the home loan laws of each of the 50 states is a nightmare, right? Well, it's that much worse online. So this issue, John, has come to the fore with respect to social media content for children, right? And the question's becoming state by state. Does somebody have to do something to make sure this is not a child and that this content is appropriate for children? And is this social media outlet appropriate for children? And there's a debate ongoing between the First Amendment on one side and the harm that is being done to children on the other side. So that's the one thing we're going to focus on. We did that program a year ago, and there were 600 people attended from around the country. So we're going to do that again to update the laws and the battles going on state by state. And the other thing we're going to do is talk about the other critical issue on everybody's mind, or that everybody's talking about, and that's artificial intelligence. And, whether you're a boomer or a doomer with respect to artificial intelligence, you cannot miss the amount of hype, the amount of capital, and the amount of profits that are being made in that business. And so it's going to define our future in ways that nothing else has. Not even fire, not the invention of the wheel. This is going to be much more massive. And I've been reading a number of people who are as pessimistic as they are optimistic. And to leave you with one sort of soundbite for that part of the webinar, in a recent TED Talk, it was noted that 50% of AI experts in this country, from Berkeley to MIT, 50% of the AI experts in this country believe there is a 10% chance that AI will lead to human extinction. Now, 10% is not a de minimis number, right?
Yeah.
Not a huge number, but it's not a de minimis number. And when 50% of AI experts say they have that fear, I think that's something to be very concerned about. I think it's something that we ought to be very careful about as we move forward. And people are seeing every day what AI can do and how AI can take control of their lives. And at some point, the convenience of the AI taking over your life becomes subjugation. And I don't know where that is or how it works. So we're going to talk a little bit about that too, also in the webinar.
We will put links to those that are interested in the webinar in our show notes, as well as links to your website. And I'm hoping personally that you don't have to do an update for your 200 years of American financial panics based on what we talked about regarding crypto. Tom Vartanian, thank you so much for your time today. Really appreciate you sharing your views and your insights, and urge everybody, both of those books are still available, as well as linked to your website and your center. A lot of good information comes out of there. So thanks a lot.
John, thank you very much.